here in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributor to Backroom Technician. This week on The Biz, the Disability Insurance for Business series, our tribute to Disability Awareness Month, May 2013. And on today's show, our business succession disability insurance with nationally recognized DI expert, Dan
When it comes to
Stenerson.
life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, suburb of Phoenix, and home to America's largest fountain. And with me today, day 4, Dan Stenerson. Dan, welcome back.
Thanks for having me.
Man, we've been talking about all that is DI in business, and today I want to talk about all that is DI in succession planning. Now, I don't want to get onto my high horse and I don't want to grind an axe today, but most of the business succession planning that I've done over my life has been life insurance.
Yes.
And my big complaint of our industry is that we all do the insurance and only a third of the business succession planning is documented. Think about that. I mean, we don't have the documentation. We don't have the buy-sell arrangement. Where's the agreement?
It's pretty amazing.
It's really amazing. And the E&O must be huge out there. I mean, just unbelievable. And with the attorneys watching my show, they're probably licking their chops in litigation right now, thinking, oh my gosh, bring that guy in as a substantial legal authority. Now, Dan, isn't it true that you've been a substantial legal authority in court cases, right?
I have served as an expert witness on a few cases, yes.
And also you've done some serious media exposure. Weren't you on some of the big channels?
I was on CNN Money and a few other radio stations and television stations around the country.
All on DI.
On DI.
Wow, that it made it to that level tells you that we're really missing the boat here. If it's already shifting up to actual national media and we're not talking about it in our practice, we're really missing it. And listen, if you're out on the web, Dan's got a ton of articles and blogs all about DI, and he's got his top 7 sales strategies on DI. If you say, Steve, I want all those, just go ahead and ask me for it at thebiz.tv. So when you come in there, sign in. Go ahead, when you're done signing, say, I want his top 7. If you want that DI stats, all last week were giving it away. Please feel free to ask for that too. Give me those DI stat packs. I love that. Well, we're talking about business succession. So when I think about it, this is the life guy coming out, so
Yes,
forgive me.
sure.
I have buy sell, I have cross purchase, I have stock redemption, I have wait and see trust, I have ESOPs. That's how I think the 5 categories. Is there any one of those 5 I say, no, that's not disability?
Right. Well, the ESOP, we generally don't get involved with that from a buy-sell standpoint.
Okay.
But the thing that each producer that's watching this should take into consideration is that if you're selling or funding a life buy-sell, there's no reason why you shouldn't be funding the DI buy-sell as well.
Well, let's just do the stats again. I mean, again, they're replete. When we look at statistics for disability during buyouts and statistics for death during a buyout, the DI stats are overwhelming.
Yes.
And yet we bypass it. Now I say the reason we bypass it, Dan, is because we look at a DI policy and we freak on the legal language. That's the first thing out of the door. Second of all, I don't know if I can explain all the possible riders, whether it's from residual to COLI to whatever. And number 3, I don't know the value. I don't know how to equate value for those riders. Should I be buying the one, like we talked a couple days ago, the 1 year? No, we're not doing the 2 year, we're just doing the 1 year. My elimination period, my waiting period. It's so confusing, especially to a mortality-driven producer.
Sure.
So when I'm looking at this, my first question comes, how does any carrier price the value of this for a succession plan? Because in life, I just have to bring out the balance sheet. I do the value, 2 for 1, 3 for 1, whatever it is. I send it to the home office. Is it different?
Well, what they're going to take into consideration, number 1 is the age. Number 2 is the occupation. Are you in a risky occupation that's going to increase the premium? Once they establish those 2 items, then there's really a very simple approach to designing a buy-sell product. 3 things. Number 1, what's the waiting period? What's the benefit amount? And what is the benefit period that benefit amount is going to be paid out over? And after that, you're pretty much home free when you're designing a disability buy-sell plan.
Well, let's just talk about the first one. Let's talk about, okay, I'm assuming the older the age, not as well then, or better, or?
The older the age in DI, the more expensive you're going to pay.
And then the other part is occupation. I'm thinking of, well, I'm 55, but I mean, I'm not rock climbing or anything as my occupation. Is it a hazardous job that I'm selling? Is that what they're looking at?
That's absolutely right. Very much like individual DI, there's going to be 5 different classifications that their carrier is going to want to put you in. The least risky, the most risky. And based on that, that'll determine or derive the premium.
Okay, so let's say I have an occupation that that's not one of the kick out, okay? So I still am in the game. And let's say my age and my ability to pay is okay.
Yep.
All right, let's just say those two. Now you're saying now I have so many options. Here's why I want to get into this, because I think if you could help us understand these three options, we might be able to sell a lot of this. Waiting period, you said, the benefit amount, and the benefit duration, the time.
That's right.
All right. Give me a little bit of potpourri on that.
Absolutely. Well, let's start with the two easiest ones, and we'll talk about the most complicated. The first easy one is the waiting period. Now, when it comes to buy-sell, there's only really 3 waiting periods. It's a 1 year, it's an 18-month, and it's a 2-year waiting period. And the reason why you might be asking, well, why is there a 1-year waiting period? Well, the reason is because you don't want to be thrown out of your business after 90 days. You want to make sure that you can at least hang on to that asset until you really know that you're not going to be coming back to work. Number 2, it's the benefit period. Couple different formulations there. One would be a 2-year benefit period. So after you've satisfied that 1-year waiting period, the benefits will be paid out over a 2-year period, a 3-year period, a 5-year period, and then lastly, a lump sum. Maybe some of your clients would not want to wait more than 2 years or a year to actually get the full indemnification of what they're insuring. And then, of course, the last item is the benefit amount. And this is really going to vary from company to company and the type of industry that that company is in. For example, a service industry might be 2 times the gross multiple, where a manufacturer might be 3 or 4 times.
So each carrier is going to look at that though differently, right?
Yes.
So so once we see the financials, we'll be able to make our real call on what carrier we're going to pivot to make this happen.
That's right.
See, to me that's an important thing. This is why I have Dan here, because it's not all the same and there's no standardization. When we come back from the break, we're going to continue our discussion on business succession disability insurance, part of our disability insurance with Dan Steenerson. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Dan Steenerson. And remember, you can order today's materials at thebiz.tv. And while you're out there, hit that top where it says The Biz Blog. And as soon as you click on that, you'll walk in, you'll see that huge banner, Backroom Technician. Click on it and go ahead and access their 30-day free trial offer. I'm telling you, you'll really appreciate it. I've been an author there for a long time, and I want you to look at it. It's the top of the line, needs analysis, sales part. It has a ton of DI stuff, the very things we're talking about. I'm using some of that material right now, and I like it, and if you like it, I think it's $50 a month. It's nothing. It'll pay for itself the first time. I've been using it 22 years for CE filing, shows, retail, and wholesale seminars. And remember, because we're talking about tax issues and so forth, always check in with your tax advisor, and if you're FINRA licensed, your broker-dealer compliance officer before using anything on the show with your client. We're talking about business succession DI. Man, I thought I knew business succession. I knew it on the life side. Now we're talking about it on the DI side. I want to talk about benefit evaluation because I thought I knew business valuation. And I look at it only as this myopic life insurance part of my practice. But you're saying, the way I'm hearing it, benefit valuation, the way you guys calculate it for DI, I think is different than mine.
It very well could be, and to take into consideration is the type of company that the business actually is. If it's a service organization, there's going to be less valuation than it would be if it was a manufacturer who has hard assets. The carriers themselves are going to cap out domestically at $2 million, and that's after a 2-year wait. So you see how that plays? The longer the waiting period, the higher the benefit that you can get. Generally speaking, after a one-year waiting period, you're looking at about $1 million that they would actually fund. So yeah, so there you go.
Okay, well, let's just go back. I thought you just did a little teeter-totter thing that I can actually get my head around. So I could have a 2-year, right?
Yes.
$2 million.
Yes.
Right?
Yes.
Now, the shorter the period, then that number is going to degrade. Maybe like in your say, it's 1 year, $1 million.
That's right. And just to be clear, the shorter the waiting period, the lower the benefit. The longer the waiting period, the higher the benefit.
And on a DI succession plan, you're saying is it per guy? $2 million is maybe the ceiling?
Well, that will be per business.
Per business.
Right.
Okay. So I've noticed that this payout benefit, once we evaluate it, okay, and we take our sheet and we do benefit evaluation. I like that. I wish I had you need to invent this, Dan, a sliding scale, right? As you go out on your elimination period, your number goes down. As you go louder, the actual benefit goes up. I think you should do that.
Excellent
and put
idea.
that on an interactive, and remember where you got that when you become famous.
All right.
You got it from me live on the show, and no, I don't want my competitors doing that. I'm already claiming the right of verbal copyright. So I want to talk to you about this, though. Combination of benefit, how it's paid out. Now,
yes,
I guess I didn't know how flexible this was. If I understood you correctly, you can have payments being made, and then it looks like, oh, you're not returning. Looks like pretty sure you're not returning. Then you can get the bulk of it at the end. You also could have the reverse, where you take the bulk of it, but then there's payments out. Talk a little about why you would take either one or why it would happen in the first place.
Absolutely, Steve. And what we see in the marketplace more often than not is what they call a down payment source of funding. So let's say, for example, you have a 1-year waiting period. After that 1-year waiting period has lapsed, a carrier could come in and maybe drop in $250,000 on a $1 million benefit. Then they take the $750,000 and pay it out over a period of time, which could be 2 years, 3 years, or 5 years.
So can I repeat? I just want to make sure I'm getting this. So on my $1 million benefit, I get a $250,000 up front. And how long are they going to amortize that? Whatever my benefit period is.
Whatever your benefit period
so
that you
the
purchase.
residual, $250 subtract, I got $750. That's going to be spread over, let's say I did it over a 60-month period.
Right.
Now, is that the farthest out pretty much they're doing? 60 months, okay, 5 years. All right, so do you ever see the reverse, though, where the guy's, he really thinks he's coming back, maybe he does, in his heart of hearts. He loves his business, or he's a workaholic, he just got to be back, he can't stay at home. But he's been taking his disability payments, the payments are coming out. And all of a sudden he makes his decision, I can't come back. The doctor says, you're dreaming.
Right.
Now you're going to get the residual all in one shot. What triggers that event that I get the rest of it?
Well, they generally don't program it that way because that could be a sliding scale, and they need to fix a time or a period in time where they can actually price it. And so if it's got that wiggle room where it's moving back and forth, they can't price it.
Okay, so if I was on a buyout and I thought, man, I'm not going to have any problems with this. They're going to give me a number I'll know going in day one.
That's right.
Okay, so I got my number and it's $1 million, and they said, well, Steve, if you go on DI, we're going to start paying you $50,000. And all of a sudden, how do I go back to the company and say, no, I'm not coming back. I can't come back. Is there something in the contract that accelerates to a lump sum?
Well, no.
Okay.
No, there's not.
Okay, so whatever your benefit is, it's going to be fixed on a time certain. You'll know exactly. Doesn't matter the condition. Once you go to disability claim, the actual benefit, the way you're describing it, is in granite.
That's right.
Okay, I just want to make sure. Okay, now, when I'm thinking about it, we're trying to evaluate the company, and I'm looking at, does it matter to you? Because you said ESOPs are off the table. Does it really matter from a DI point of view, from a due diligence point of view, financial point of view, whether it's buy, sell, cross purchase, stock redemption, or wait and see trust? Does it matter that any of those are being used?
No, not at all. Not
so
at all.
It's easier for either any of those.
The trust would not be a product, or excuse me, an entity that they would want to issue the coverage on.
So really, when I think about it, out of the 5 what I call conventional succession planning issues, the wait and see trust would be off the table in ESOPs.
Yeah, that's correct.
All right, but stock redemption, buy, sell, cross purchase, the same thinking that goes behind mortality life insurance is probably the same for DI.
That's exactly right. Right.
Well, I've learned something new on the Business Insurance Zone, and I'm supposed to know what I'm talking about. Remember, you can watch all our DI shows this week featuring business disability. It's great on our website, thebiz.tv, and follow me on Twitter, Facebook, LinkedIn, Pinterest, and Google+. That's the Buzz on the Biz for today. You've been in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.